make better trading decisions. As a second-generation trader with over 10 years of profit and experience getting paid a salary to trade, it shocks me how many people on YouTube know so little about trading, yet act like they know everything. In trading, there are two types of information: definitive and speculative. It's possible to trade profitably using both. However, if you take definitive information and treat it as speculative, it's a quick sign that you're likely to be an unprofitable trader. Let's break these down and give you some examples. Definitive information is data that cannot be argued. For instance, if I told you a stock traded between 19.24 cents a share and 24.98 cents a share on July 22nd, this is definitive. It's factual. There's no debate. Definitive information is a great place to start when creating a trading plan. It allows you to see the market for what it is, not what you want it to be. More on this to come. Speculative information, on the other hand, can be argued. For example, if I told you the only time you should trade currency is between 3 a.m. and 5 a.m. EST, you could easily argue that there's a better time. It's difficult to prove otherwise without further context. Math and statistics fit perfectly into this concept. 1 + 1 is 2. You can't argue against that. However, if I said there's a 64% chance that tomorrow's price for GBP CAD will trade to 1.80898, without knowing how that number was calculated, you could certainly argue against it. As Harvard professor Joe Blitzstein said, math is the logic of certainty, probability is the logic of uncertainty, and these two types of information can make or break your trading career. And truthfully, they are the exact reason most traders fail. But if you stick around to the end of this video, you'll not only know why, but you'll be able to ensure it doesn't happen to you. If you aren't profitable, start by understanding the mechanics of the market you're trading. Would you trust a car mechanic who didn't know what the brake system was? In the same way, you should understand the mechanics of the markets and what drives them. Don't look at all markets the same way, because they aren't. Definitively, we can prove that over the long run, both stocks and real estate tend to increase in value if the country experiences economic growth. However, this is not true for assets like currencies or commodities. The mechanics are different. For example, we know that natural gas is primarily used to heat homes. So it's no surprise that during colder months, natural gas prices increase. Crude oil, on the other hand, isn't primarily a long-term investment. It's a short-term commodity, mainly used for energy. Let's take it a step further. Crude oil, the black tar-like substance often drilled out of the ground, can't be used in cars as is. Refineries buy crude oil to process it into gasoline. The gap between crude oil and gasoline prices is the potential profit margin for refineries. The wider the gap, the more likely refineries will buy crude oil. The smaller the gap, the less likely. See where I'm going with this? To avoid making this an hour-long video, check out our playlist on currency and how to trade it. The link is in the description. So, what is speculative information? Speculative information is data or insights that aren't set in stone. They can be debated or challenged. Unlike definitive information, speculative information involves assumptions or predictions about future events, outcomes, or market movements that are not guaranteed. Let's use a simple analogy to explain the difference further. Imagine you're planning a road trip. A definitive information is knowing that it takes 4 hours to drive from your town to a nearby city without traffic. This is factual based on past experience or GPS data and can't be argued. Speculative information would be predicting that tomorrow at 8 a.m. traffic will add 30 minutes to your trip. And this could be right or wrong depending on factors like weather, accidents, or unexpected construction. In trading, this distinction matters a lot. Think back to the quote from Harvard professor Joe Blitzstein. Math is the logic of certainty. Probability is the logic of uncertainty. When we use math in trading, we lean on definitive information, fixed values, historical prices, and factual data. But when we apply probability, we enter the realm of speculative information. For example, you might use historical price patterns to predict a 64% chance that GBP CAD will reach a certain level tomorrow. But that's speculative because despite the probabilities, the outcome is not guaranteed. Why is this important? Because speculative information can easily lead traders astray if they don't recognize its uncertainty. Many novice traders fail because they mistake speculation for fact. They think if this indicator shows a 60% chance of price moving up, it will move up. But that's not how probabilities work. Even with a high probability setup, there's still a chance it won't play out. If traders don't account for that uncertainty, they may take unnecessary risks. Successful traders know how to balance definitive and speculative information. Think of a car mechanic. They must know how the brake system works definitively, like understanding market mechanics. But predicting exactly when your brakes will wear out is speculative. Without understanding both sides, the mechanic wouldn't make good decisions about when to replace your brakes. Just as a trader might make poor decisions without distinguishing definitive from speculative information. To apply this to your trading, start by mastering the definitive facts about the markets you trade. For example, the seasonal trends in natural gas prices during the winter, or how crude oil prices are influenced by refiners' profit margins. Then layer on speculative information predictions based on probabilities, like how interest rates or geopolitical events might impact prices in the short term. A key takeaway here is that speculative information should be treated with caution. It's useful for developing strategies and predictions, but it's never a sure thing. The best traders treat it as one piece of the puzzle, not the whole picture. By grounding your decisions in definitive information and recognizing the speculative nature of other data, you can build a solid foundation for more consistent and profitable trading. This balance is crucial in making better trading decisions and avoiding the common trap of mistaking speculation for certainty, which can lead to significant losses. This is what allowed me to be profitable trading gold and oil. In fact, I believe these assets are some of the best for new traders. If this video gets enough likes and comments, I'll show you the exact indicators I use for gold and oil and how they form part of a simple trading approach that anyone can use. For now, here's what I want you to do. Start looking at markets as individual assets. Ask yourself, what is definitive about them and what is speculative? Then think about how you can use this information to your advantage. If you found value in this video, don't forget to like, comment, and subscribe. Let me know in the comments what you'd like to see next, and check out our playlist for more in-depth content on trading strategies. Thanks for watching. Signing off.